In this video, I'm going to be breaking down this exact trade I took on USDJPY, a trade that made me over $1,000. And I'm going to walk you through it from the top down using the exact concepts I teach on this channel and inside the MacFx Academy. Concepts like market structure, supply and demand, imbalance, and volume. No hypothetical setups, no hindsight analysis. This is a real trade broken down in real detail. All my analysis starts on the higher time frames like the daily chart where we are looking at right now. And what I like to do is build a picture of the higher time frames and where price is likely to go on these higher time frames before I work my way down to the lower time frames where I start to formulate entry ideas. So by looking at the daily time frame, we can clearly see price is in an uptrend. We had a break of structure at this point right here. Therefore, we know it's likely that price may continue trading higher. Now, since we know price is likely to trade higher, what I typically like to do is find a target that we can look to target. So if we scroll back in time, we can see we had this sell-off right here, and this sell-off left a supply zone, and the supply zone had imbalance leading into it. Now, the way I trade is that I put a lot of weight on imbalances being filled. So we have this imbalance, which is this large price range left open after the supply zone drove price to the downside. Therefore, it's likely at some point in the future, price is going to come and fill this imbalance, right? And once it fills the imbalance, then we can assess whether price is going to continue selling off from the supply zone or continue pushing higher. But right now, we don't need to think too far ahead. All we know is that if the market gives us reason to, we can target this imbalance because we know it is likely going to be filled. So now we have a clear target. We can clearly see price is in an uptrend, breaking structure to the upside. Now we can start to jump down to the lower time frames to get a better idea of finding potential entries. And I do this by dropping down to the 4-hour time frame. Now on the 4-hour time frame, we can further start to refine our idea. So you may have noticed this volume indicator at the bottom here. And I use this in my trading on a daily basis. It is probably one of the best tools I have in my trading. And I use it in conjunction with market structure, right? To get a good idea of where price is likely headed next. Now, the way I do this is simply by looking at the high volume bars. Now, these high volume bars are the likes of the big banks, okay? It is the large financial institutions because what these volume bars represent is just tick volume. So the amount of price changes within every candle. Now, what does this mean? Well, if it's the amount of price changes, we can look at it in the same way as, okay, if price is changing a lot at a certain level, then there are a lot of orders happening at that certain level, okay? And who is responsible for putting on a lot of orders in the market? Well, it is the big banks, okay? Only the big banks have the capacity to put such large orders on at a certain level compared to retail traders. So what this volume bar tells me is that when price is trading lower, we want to look at high volume at lower prices. Why? Well, because if price is trading lower, the banks want to essentially buy at lower prices. That's how it works. They want to get the best possible price for their position. Now, they don't just simply want to buy at any price because that would take price higher and they actually won't be able to put on their full position at a lower price, right? So what they do is they buy into the retail traders who are still selling. So the retail traders will naturally be selling. And what the banks do is they buy into these selling orders so that they can put on their large buying position. So lower prices are telling me about buyers. Now, as we can see with this large volume candle here, on this down move, we get wick rejections as well, okay? So volume paired with price action, we have this wick rejection, which pushes price back to the upside. Again, when price then comes and sweeps this low, pushing into new lower prices, what can we see? The volume increases, right? So the volume increases at this level again, which is telling me that the banks are possibly stepping in and buying into this retail traders who are selling. Okay, they're putting these large orders on with the idea to take price higher. Now we compare this with supply and demand, and we can clearly see price traded into this imbalanced demand zone. And this demand zone is imbalanced because we can clearly see this wick did not go and retest this demand zone. Okay, so this demand zone is untested, right? So once we swept this low right here, traded into our demand, price then started pushing back to the upside. And this is where my idea started to formulate that I wanted to buy this market and I wanted to take price higher. So what I did now is drop down to the 1-hour time frame. If you feel like your trading is lacking confidence and want to understand how volume can completely change the way you read the market, I've put together a free mini course that covers exactly how I use volume within my system to find the highest probability setups. I'll link it in the description and in the card above. And on the 1 hour, we can get a better idea of the volume. Okay, so where can we see this high volume? Well, we can clearly see it's right in these lows, right at this wick rejection, right? So after this large sell-off, okay, the retail traders thought, okay, it's a good time to continue selling off, okay? Maybe panic selling right at this point because they missed the initial large sell-off. So they wanted to still sell into this push down. However, the bank saw this as an opportunity to start putting on their buy positions, okay? So they're buying into these retail traders who are still selling. Now, the volume alone doesn't tell us that, okay? So simply seeing high volume doesn't necessarily mean that we should immediately start looking for buys. We have to pair it with market structure. So after we see the high volume, what can we see? Price slows down. We have formed this range and starts pushing back to the upside. Now, again, when we sweep through this low, so we form kind of relative 3 equal lows here, price sweeps through it, trades into our demand zone, and what can we see? High volume again. So the banks again are stepping in and buying into these retail traders who are still trying to sell this market lower, and they're putting on their large buy position. Now again, the volume doesn't tell us this alone. We need to pair it with price action, okay, market structure. Now after this, we can see price clearly starts trending to the upside. So it was at this point when we had this dip down, and again, what can we see? Look at the high volume. Look at the volume. Now it's clearly not as high as these volume bars over here. However, it doesn't need to be, okay? So this is where the banks put the initial large positions, large orders on. This, which established this uptrend right here. And now price dipped lower. We see the increase in volume, which tells us, okay, the banks are buying at these lower prices. Every time price moves lower, they buy. Price moves lower here, they buy into this. Price moves lower here, they buy into this. Price moves lower here, they buy into this. So it was at this point where I went for a somewhat aggressive entry, okay? So I simply, on the 1 hour, I placed my order like this. I put my stops beneath this wick right here because if price were to, break through this level, it's likely then going lower anyway, and I wouldn't want to be in the trade. And then I put my targets up here. Now, a more conservative approach would be to wait for this break of structure. Okay, so wait for price to cleanly make a reversal, so a lower low, lower high, lower low, and then break into a new higher high before looking for buys. However, that is the beauty of this volume tool, because we can clearly see that the banks are stepping in at these lower prices. There is a lot of orders being placed at these lower prices, and then there is willingness for price to push higher. And again, when price dips lower, we see the banks buying into these lower prices again, looking to take price higher. So it is somewhat more of an aggressive entry than what I would usually go for. However, the volume was there, the demand zone was there, the volume, the willingness to push higher was there, and the targets were quite clear that, imbalanced targets get filled. So I was quite happy to go for this position, which was a 7%, 7R position. Now I did take partials, so I ended up with slightly less than that. But if we let price play out, we can clearly see that we range or hang around at break even for some time, and then price eventually takes off in our direction. Something to note again, when price dips lower, what can we see? So we dipped lower into our entry. What do we look at the volume? Look at the volume here, high volume at lower prices, followed by higher prices, okay? So price, after this dip down, we see the high volume followed by a push higher, which is clearly telling us that the banks are actually buying at these lower prices. So jumping back to the daily chart and letting price play out, we can clearly see we get a nice clean run to our targets. And that is exactly how I found this trade, which made me over $11,000 using just 4 concepts: market structure, supply and demand, imbalance, and volume. No complicated analysis, no fancy indicators, just a clean, simple setup. The best trades are always the boring ones. This is the type of trade I take on a regular basis, and it's exactly what I teach inside the MacFx Academy. If you want to learn how to find and execute setups like this and trade alongside me and the network, the link to the full course is in the description. See you in the next one.